Hi guys, welcome to Trade for Learning channel. This is a channel where we will learn option trading as a business. So today I'm going to cover topic what is this options? What is this option trading? As you all guys knows, most of them they are already aware of like trading, intraday, investment, swing trading, and what is this terminology means, because most of them already tried and invested or maybe like indulge themselves with the money into the market. They might end up with a small profit or big profit or small loss or big loss. So in this whole journey you would have heard this term called options, and you have this curiosity what it is options. So let me start with this simple example and explanation how and this option strategy options works and what is this options, and then how differ from this stock market when it compared to single stocks that you're going to buy or trade with the stock, and what to trade with the options. And I can't cover all those things in a single video, so I'll be splitting all these topics into a small video. Today we'll go into cover what is options, options selling, options buying, what it means with the basic and simple examples. So guys, if you still not yet subscribed to this channel, please go ahead and you can subscribe to these channels to get the latest video with a basic and simple and easy explanation about the topics. And as of now I already started with a paper trading strategy for options, and I'm keep on updating for every weekly update, hedging, all those things. In this video I'm going to cover only basic things called options, what is options and how it differs from the other options stock market. Okay, what is option? So when it comes to market, there is a stock that with a fixed price, so you will buy that or you will sell that in a trading way. And when it goes opposite to your directions, like if you buy and it is when to sell, then you are in loss. If you buy and it reaches higher price, you will be in profit. If you sell, if it reaches a lower price, you will be in profit. Option is nothing but the derivatives. It comes under derivative. It means the extraction of this portion of market. It may be like a Nifty 50 or Banknifty, the collection market. For that you are betting. You are betting on a market trend, index trend, or the particular stock trend. So what you're betting is called a strike price. It means like you are buying some. You are assuming or you are planning this market, whole market, to be in this level before certain time. That is called options. If your assumption is correct, then you will be with a huge profit. If your assumption is wrong, then you will not have any money. You will lose all the monies. That is called the prediction. So this prediction they converted into a topic called options and term called options, and that will be traded in market. So let's see. Obviously for any stock market we should have a one buyer, one seller. Let's convert this whole buyer seller concept with these three categories, not three, like totally five categories for each buyer and seller. So here when it comes to options we'll call it as a premium buyer, and when it comes to sellers it's called a premium seller. Premium buyer, obviously he is going to buy a particular premium, so investment is minimal. I will tell you in brief what it is. And seller is have a capability of giving the premium, so you should have a more investment called max investor. And loss is a minimal up to his premium what is paid, and max loss is maximum, maybe like a huge loss if he didn't handle. And usually the premium who is going to buy, I mean buyers, it will be like a trading. Those who are selling this, they can run it as a business. So that's why always options buyers are retailers, option sellers are huge companies or like reputed companies like a bank, financial institutions. So buyers also considered as an insured person, or seller as considered as an insurer. So let's take a simple example here. For example, you might have bike or car your own bike or your own car. So obviously for each year you have to renew your insurance. So what it means, like for example you have a 10 lakh car, you'll be insured with some 10,000 per year. It means if something goes wrong within that year, I mean call a period, then that particular company will pay you the loss that you occurred up to 80% or 100% based on the damage happened to that car, if that occurs within that year. If nothing happened, then whatever the premium amount you paid, the 10,000, that will be lost. You'll never get it back. So it means for the secure purpose, always a car owner will buy a premium, insurance premium, and obviously there is opposite side where this premium will be sold, selling by big companies like ICICI, Lombard, all those things. You would have heard that insurance companies. So it means, do you think that buyer is a person who is always make a profit from this, or seller is a person? So when it comes to selling a premium or buying a premium for car, so buyer will not have a mentality of getting or earn something. He's just for precaution purpose, he is buying the insurance with the 10,000. Seller is always not selling this because of precaution, he is selling because of running a business. So that's why I'm calling option buyers is like a trading or speculation. Option seller is something like a business who will run in a large quantity. So that's why when you're running a business, you need a big huge money. When you're trying a trade, you need a small investment. Here the interesting part is when it comes to probability. So when you buy any car with and when you invest a premium for insurance, how much percentage that you will get that premium benefit. For example, you bought a car and you paid some 10,000 for a year, and you never encounter any accident within that year or any loss, then your whole 10,000 goes to insurance company. And similarly, vice versa, if something happens, insurance company might provide almost 80% of your car value or 100%, but the probability of insurance company paying to car owners is 1%. The probability of premium buyers, insurance buyers, will lose the premium per year is 99%. This is how actually options works. It means options buyers who will guess at strike price by saying like it will reach a certain price within this time period, and you'll give some small premium for that. If that reaches that certain assumed target or above, it may be target in a upward direction or low direction, then he will make a huge profit. But most probably 99%, 99 times he will not get this profit. But the seller who will sell this premium, he is guessing that market will not reach till to certain range bound. It may be like above or below, and he'll just sell this premium and he'll collect the premiums, and whatever the collected premium is certain amount, like small amount, and he'll earn only that premium amount, not more than that. But if in case vice versa happens, market reverse and cross the premium buyer's target, then seller will lose huge money. But still, when you compare to this buyers and seller, when it comes to long run, always sellers win, buyers lose. That's what we assumed and experimented and saw in whole our market. So this is completely about probability of buyers and sellers. Like always, probability of buyers is 99%, he'll lose. Sellers always like 1% he might lose. So most probably when you treat it as a trading, as a business, always sellers will win, buyers will lose. I'm not saying that buyers will not earn money, he will earn, but the probability of a per person earning is varies. Sometimes one person might earn, another 10 times a person has to lose. That losing money will go to all sellers as a premium, and one seller's investment will be going to buyer as a earned money. This is vice versa happens. So that's why when you treat it as a options writing or selling as a module of business, you will be in a good profit for long run. So regarding running it options selling as a business, I already explained in different videos that you can go and refer. For this video, this is a basic example that I think you guys understood, like what is option selling and what is option buying, with the example of like car premium buyer, and insurance as a insurance, and insurance seller by organizations, companies. So let's move on to the next video. In that, I will be explaining what is the strategy that seller use to make a consistent profit and how it benefits for the person who is continuously working in a company or some business, and he can't involve himself continuously in the market, but still he can earn a small piece of amount from the market every week. Why I'm saying every week is like, as I told you, like when you come to buying a premium and selling premium, I told you that time period, right? This time period when it comes to insurance companies, 1 year. Similar way, when it comes to stock market, it varies from weeks to month. So as of now in Indian market, Banknifty is the only thing that is applicable for weekly expiry. All remaining stocks are index, they meant to target for 1 month. So as of now, we got information like they're going to do the same weekly expiry for Banknifty, Nifty 50 also. So as of now, it was there for Banknifty. So using Banknifty itself, you can earn more weekly profit, like a small profit in a long run, so that you can run it as a business. That I will explain in the next video. That's all from this video. Thank you guys for watching this video and understanding the basic concept. If you have any doubt or any clarification, you can comment to this video. You can refer that, or also you can refer the strategy that I am tracking with option selling in a track sheet and documents that I mentioned in this note or comment section of this video. If you guys still not yet subscribe to this video, please subscribe, like, comment, share. That will help me to create new videos with the simple examples to make it understand what is options or how to utilize the option selling strategies to run it as a small business. Thank you guys. Thanks for watching.